Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today we have the pleasure of having Mr. Michael Becker. And Michael Becker is one of the who's persons right now in the multifamily world. Welcome, Michael. I appreciate it.
Thanks for the nice introduction. I appreciate that. I don't know for the who's who, but we're
Absolutely. I think if someone doesn't know who you are, my goodness, they are hiding under some rocks. So a little bit about Michael. Michael is a principal with SPI Advisory. With his past lending background, he's scaled his business. He's done over 800 million worth of units. Currently, they own close to 4,500 units. Just about, you said, how many million you said? For 500, 600 million you said, Mike?
Yeah, it's probably, portfolio is probably north of $500 million in value today.
Awesome. So let's roll back a years, Michael. Give us a brief background as to how you got started. How was your first deal like and things like that?
Yeah, so thank you for having me first off. So Michael Becker, I'm based in Dallas, Texas, and the way I kind of got into the business was I was a vendor. I was a banker. I was loaning money to other people, and I have a background in loaning all the major food groups of commercial real estate. So I've lent on industrial, retail, office. In the last 5 or so years of my banking career, all I did was multifamily lending. And so I was just making a loan to a bunch of other people, and then kind of realized that I was on the wrong side of all those deals. It was kind of better to be the borrower than the lender. So I started out in 2010, 2011. I started buying some smaller stuff, some like houses with my own money, no partners, and ended up scaling up to about 16 rent houses. And I realized that wasn't very scalable. And then so I kind of reflected back to what I was doing all day, every day at work. And so I decided to transition into a larger scale multifamily. So in 2013, so about 6 years ago, we bought our first deal. And as I talk to you today, we've done 33 deals, about 6,700 units. Today we own 20 deals, about 4,500 units. So I've gone full cycle so far on 16 of my 33 deals. I've sold 13, and then 3 more we've refinanced, returned some principal, and still own the deal today. So it's been quite the busy 6 years, no question.
Sure. And what is your investment strategy, Michael? Like, I know some people say that, hey, we're going to own the multifamily long-term and things like that. So are you a permanent long-term hold guy? I know you exited some deals. What is sort of your philosophy around this?
Yeah, so our basic business model is pretty simple and straightforward. So we do light value add. So we're just targeting deals that are, call it 10% or more below market rents compared to their neighboring properties that have, generally some sort of physical issue or management issue or some combination of those two things. And we try to come to the deal pretty well capitalized. We cure any sort of deferred maintenance that might exist on the property. And then we set aside money up front to implement our value add strategy. So we'll, upgrade like the common areas, like the office, fitness center, pool. And then we'll go inside the units and do appliances and flooring and light fixtures and cabinet fronts and things like that. Sure. And after we come in and make a better product, we come in and charge a higher rents that our properties on the street get. And then when you increase the income, you by extension increase the value. And that's our basic business model. We're typically targeting about a 5-year hold period on most of these deals. Quite frankly, when we first started out, we did a lot of workforce housing, a lot of like C-class stuff. And those deals, weren't deals that we wanted to own quite as long, just because they're just, a lot of the building components are kind of functionally obsolescent. You just have like cast iron sewers and boilers and flat roofs and stuff like that. So you have a lot more ongoing maintenance to those types of buildings. And kind of what we buy today is a little bit nicer, kind of A- type stuff. So maybe like the early 2000s vintage. And those deals have a little bit better construction components. So they're just a little bit easier to operate. So I'd foresee us owning the deals that we own today a little bit longer, but we typically underwrite to a 5-year hold is pretty standard. And then, how the market plays out is kind of how it plays out.
I see, I see. And which are the primary markets you operate in, Michael?
Yeah, so I'm based in Dallas, and so and then my business partner is based in Austin. So those happen to be the two markets that we just buy in. So the vast majority of what we've been done has been up here in North Texas, and we've done a couple deals. We have a little bit over 600 units in the Austin market, and as we talk right now, I have two deals. I'm buying one in Fort Worth, and we're buying one in Austin. So we'll be about 900 units in Austin. About 7,200 overall that we've done here shortly, and if everything goes planned. So
awesome, awesome.
yeah.
So in your early years, let's roll back a little bit, Michael.
Sure.
In your early years, when you had single family, what were sort of the limitations you had noticed, and how come you sort of quickly scaled into syndications? And obviously, you are a big force now. Could you maybe give our listeners sort of insight into why syndication is a powerful way to scale and get into bigger and better deals?
Yeah, so I don't know if what I did was the right thing, the wrong thing per se, but with the benefits, the margins that you can get on, especially when I was doing it, it was a really good time to do it. A lot of homes just kind of buy out of foreclosure, so there's a lot of really good deals. But you're on a gross percentage basis. I think you can probably make more on a percentage basis doing some of the smaller single family. It's a less perfect market, a lot more opportunities, a lot less sophistication within there. The problem just is scale. I got to 16, I was self-managing it, and I had a job and a wife and kids, and it was kind of hard to stay on top of all that stuff.
Sure.
So it would just lack of scalability. And if I killed it, I'd make 30, 40 grand on a deal. And then if you do a really good job as a sponsor in the multifamily space, you can make millions of dollars. So on a gross basis, it's just better. And so I decided to kind of form up a partnership with my partner, Sean. And then we just kind of went out. And so I felt like, it's a really good business from the standpoint. It's like, almost like perfect leverage. So you have not only the financial leverage where you can go in and get the bank to loan you 70 or 75% of the purchase price or the total cost, and then you can put a little bit of your money down, and then you can leverage a network of investors to then bring the bulk of the capital with you. So maybe we put in 5% of the money or 10% of the money that's required, and then get the rest, so the 90% from a bunch of other people, 100,000 at a time. So I can leverage their money, their resources, and then I can then leverage a management company to then do most of the day-to-day work and kind of lease my properties, turn it over, make it ready. And then, my investors can leverage my expertise, my connections, et cetera. So it's really, when you think about it, I think about it like almost like a perfectly leveraged business. All the time, you have great tax advantages, and you can avoid paying a bunch in income taxes legally by depreciation and sheltering your income. So it's, if you find a better business, let me know. But this one's pretty good.
No, I agree with you. I think just the value of syndications, that you bring so much value to other people. There's a lot of capital. There are a lot of busy professionals always looking for a safe haven that they can invest. And obviously, gain good equity multiples. I mean, we see deals where, people have gone like more than, double their money in 3 to 5 years. There's definitely something to be said about that. So speaking of syndications then, Michael, how do you structure your deals? Like, how is your general partnership, limited partnership structure? Could you?
Yeah, so we're pretty straightforward. We just kind of started doing this, and we really haven't deviated much. So when we do deals, there's really three forms of compensation in these deals for us as sponsors. First and foremost, we'll typically take an acquisition fee on the front end. So we've charged anywhere from call it 1% to 3% of the purchase price.
Mm-hmm.
And the bigger the deal, kind of the smaller percentage. But I'd say on average, it's about 2% with us
Right.
here lately. The second way we tend to get compensated is through asset management fee income. Mm-hmm. So when we buy a property, we employ a third-party management company, and they've charged us anywhere from like 2.75% to 4%, depending on the size of the deal. So again, the bigger the property, the more units, more revenue produces, kind of the smaller they charge. Mm-hmm. Let's say we pay them 3%, and then we'll take a 1% asset management fee. So if it's 3 to them, 1 to us, it's 4% of collective revenue to the deal, but we'll get 1% of that. And then finally, the way we do it is we'll take what I call, or I refer to as sponsor equity, but you can call it carried interest or promote or whatever you want to. Mm-hmm. And our typical deal is an 80-20 split, where us as the sponsors will take 20% of the deal, and then the investors get 80%. and then we do not pay a preferred return. So there's no, in my experience, there's no right or wrong way of doing this. I know a lot of the sponsors will pay like a 6 pref or an 8 pref, and then have a graduated waterfall that, above
it does
that
get complicated.
It just gets complicated. So you just need to kind of understand who your investor is. And one of the things I've kind of learned, or this is a popular saying, is a confused mind doesn't buy. So if people don't understand and can't simply understand what you're putting in front of them, they'll be confused and they won't proceed forward. So we just try to be extremely straightforward and simple, and it's worked really well for us.
Right. And I think you can't make someone sort of take that leap sometimes. I mean, you can teach or, impart knowledge to a certain extent, but if someone is really insecure or, unsure about themselves, it's really difficult, in my opinion. That's what I have discovered. So sometimes, I think we share the knowledge, and I think we kind of leave it at that. I think at some point someone has to self-educate and kind of gain an understanding of what benefit it brings in. Would you agree?
Yeah, that's right.
Right. Got it. And no preferred returns, you said, Michael, there. Could you maybe share some thoughts? Because I know a lot of, investors and multifamily sort of syndicators do have preferred returns. Yeah. Could you share some thoughts as to why you don't?
So again, there's no right or wrong. And just because I don't do it, someone else doesn't make them right or wrong. So some of my thoughts around it, as a from the passive investor standpoint, I'm a little worried about the preferred return, and then from the standpoint, you think it's better because I understand what's attractive, because from a passive standpoint, it's like I'm guaranteed to get my money in the first 8% return before the sponsor starts getting paid. But I think it has the intention or the possibility of disaligning interest, and what I mean by that is, so me as a sponsor, if I have to pay an 8% preferred return, and I go into year one and I can only produce a 6% return. So what happens is I pay my investor 2% is accrued and carried forward. So then I'm going to go to the next year. So then I have to pay the 8 plus the 2, so I have to pay 10. And say we hit a recession, I can't pay anything out that year. Right. So then I go to the third year. So now I got the 10 I carried forward plus an 8. Now I got 18. And I'm, as a sponsor, looking like I dug myself a hole, and I'm digging deeper and deeper. Looking out, thinking like, well, man, I'm never going to make money in this deal because I'm so far behind on my pref. Let me just go ahead and sell this deal. Let me just make some decision that may or may not be the right thing at that moment in time for the deal, but I have no possibility of ever making money in the deal, so I'm so far behind. I just want to I don't want to work for free anymore. Let me just fire sell this deal and move on in my life. So that's I'm saying there's not a right or wrong way to that, but that is certainly something I don't think a lot of passive investors kind of really take into account of the potential to disalign interest due to having the preferred return versus the way we do it. And we could participate, along the way. It kind of more perfectly aligns interest in my estimation. But yeah, those are my 2 cents about it.
Right. No, I get it. I think simple, straight, clear, and just be sort of concise about it. I think that's kind of how your approach looks like. Now, speaking of value add, you said earlier, Michael, that you are looking at sort of a 10% rent differential to sort of give you that growth, right? Why not deep value add? Sometimes with the scale, the capital, and things like that you have at your disposal, why not maybe go for killer deals where you get some unbelievable returns within 3 years, that kind of thing?
Yeah, so we certainly have had our fair shares of home runs along the way too, but we've always kind of done the light value add. A couple reasons. What I'm always striving to do is try to produce the best risk-adjusted returns. So I think that's one thing that's been kind of lost here lately, especially with some of the newer syndicators, some of the less experienced people that people are investing with. And there's nothing wrong with that. Everyone starts with their first deal, but if you're looking at 2 properties and one of them is in a nice affluent suburban market in your town, and you look at the other one that's in the ghetto in the hood, and they both produce a similar rate of return, the risk of those 2 properties are different. So if you're going to go to something that's got more deep distress and value add, you need to make sure that you're getting compensated by having a higher return. I feel better about if I can just find something that I can walk into that works day one. It just doesn't work that well. And then through my efforts, through the management improvements, to the capital I'm going to apply into the deal and,
Mm-hmm.
physically improve and transform the physical condition of the asset. And I can produce a current yield pretty much from day one to my investors that
Mm-hmm.
is maybe a little bit smaller than as I turn unit over unit by unit, month by month, lease by lease. I kind of generally increase the income as we go along, and I can increase cash flow along the way. That just is a safer deal to me. So that's the main reason why we focus more on the light value add. And then quite frankly, just to where we are in the marketplace, there's very little distressed stuff. It's been like a booming economy for nearly a decade at this point, 8 years deep in this expansion cycle or more. So there's not much distress left. So if you have a property that you're buying today that's super distressed, there's got to be something extremely wrong with
Something majorly wrong,
or a location, because even that properties are full today. So it's I just don't see a whole lot of it. And then the other part of it is we're to the point where I can't deploy $1 million, $2 million anymore. We've gotten so big that it's just not efficient. It's not a good use of time. So
You're absolutely right. You're absolutely right. It's definitely a sort of a factor that, as you gain bigger, you want to go from transaction to transaction without having such such a project, as I call it, that you kind of stuck. And as we all know, in these deep value components, there's just so many other issues that can pop up.
Yeah, so there's nothing wrong with it. It's just our philosophy, and that's just not kind of what we want to take on.
Sure. So I know, Michael, you are, for example, in Dallas now, right? So what are your thoughts on markets? And what I mean by that is, you got Floridas of the world that are thriving too. I know Dallas, Austin are really hot. Great job growth, population growth, things like that. For anybody new out there, what advice would you give that if they have to look out of state and things like that, how can they go about kind of drilling down into submarkets and things like that?
Yeah, so I'm fortunate enough. I was born here, grew up here in Texas, and I was happy to live in an environment that's kind of a great environment to do what I do for a living. So, but a lot of people don't have that same thing. So maybe you live in a really small area and you just don't have the available product because you live in the middle of nowhere, or maybe you live in California and the cap rates are so low and stuff. So what I kind of look at and what I like about Texas and Florida kind of falls in the same place too. There's other places across the country as well. Just because I'm in Texas and I invest in Texas doesn't mean it's only good markets. But what I would kind of look for would be, kind of first and foremost, find an environment that's landlord and business friendly. So, in Texas, if you don't pay your rent in, say, Texas, you can be evicted in 30 days. If you go to, California, the District of Columbia, or New York, it could be 6 months, 9 months, to get someone out. And so you have these professional tenants that live there. So find a business and landlord friendly environment. I want to find a place that has population and migration. So, Texas, Florida are two good examples of that. We have no income state tax in both state income tax in Florida and Texas. So we're seeing lots of corporations relocate. The cost of living is a little bit more affordable. So they're moving from New York to Florida and they're moving from California to Texas. And these people are coming and following the job. So we have, population and migration. The biggest struggle or the biggest risk in these deals I have no control over would be, and the biggest thing that's hard to defend against is if you have population outmigration. So the example I like to use is if Dallas ever one day turns into Detroit and half the city moves out, the population shrinks by 50%. It's going to be really hard to be successful owning apartments. So I want to be in an environment where the wind's kind of in my back than more my face. When you go to California, they didn't pass it, but Oregon just passed like statewide rent control. So like you get stuff like that. That's very difficult. And then we're just looking kind of the specific submarkets. I'm personally, we focus on suburban multifamily and better school districts, near retail, near thoroughfares. Going to take the 101 seriously, but I know a lot of other people might be more specializing in like urban core stuff. And there's no right or wrong in this business. As long as you find something and you understand it. And what I found is specific knowledge mitigates risk. So if you have specific knowledge about a type of product, a location, a submarket, you will be much better in that market than I will be if I don't have that same specific knowledge. So get that specific knowledge, it'll mitigate your risk. And a lot of people make a lot of money doing a lot of things I won't do, but they understand what they're doing. So that would be the way I answer it. But about your markets, population, immigration, business landlord friendly, job growth, low income tax states. I think those tend to be the winners today and the recent past, and I think they will be the same going forward.
I see. Yes. Now, speaking of syndications, Michael, how you go about raising capital? I know, I guess that's not a concern nowadays with the amount and the scale that you have.
Always a concern.
But I guess, you probably have a 25 million problem than, somebody new who probably has $1 million problem. But,
Sure.
In all seriousness, like when you started, right? So how you went about raising capital, can you give us maybe some tips and tricks?
Yeah. So we're syndicators. So we'll just go take, a bunch of high net worth people and we'll raise $100,000 at a time. So, I was mentioning we had a couple deals. So next Wednesday, as we record this, I'm going to have a webinar and we got to raise $24.6 million and try to get it done in 3 weeks. And we're going to blast out to thousands and thousands of people that are in our database. And we got to get, my average checks today is about 130,000 is my average check. So I got to get somewhere between 180 and 200 people to give me money to get raised $24.6 million. So some tips, I didn't start there. This is my 34th, 35th deal. So some tips, kind of how you get going and then how you kind of scale. The first people that are I found that are going to give you money, it's kind of like the 3F rule. The first people that are going to give you money will be your friends, family, and fools. Those are the people that do it. So people that know, like, and trust you, or people that just don't know any better. Those are the people that are going to give you money, because when you're starting out,
I knew the friends and family. I didn't know the third F.
Yeah, fools, right? Those people that just don't know any better, because when you're starting out, you don't have a track record, and there's a different risk profile investing with a guy like me that's done this 33 times than answer you on your first time. Because when I see something, I've probably seen, whenever the scenario comes at me, I've probably seen that's the exact same scenario, something very similar. So I know what the right answer is. And when you're starting out, that's one of the hardest things to do when you're starting out, is you just don't have a reference point on anything, because every time you're doing it, it's the first time. So every decision is difficult, and every decision you have to stop and think about, and like, what's the right decision? Well, once you do it a while, it just becomes like second nature. So tips are, you start kind of with what you have. So everyone starts with what they have, where they are. You're young, you're old, you're black, you're white, you have money, you're broke, you have some professional experience, or you don't. So the first thing I would say is you just kind of start with, like, do a really good personal assessment about what do you have and what are the things that you bring to the table. And then when you're going out and putting a deal together, the way I think of it, it's just like putting a puzzle together. You got little pieces, and you got to put all the pieces together. And at the very end, the picture becomes clear. So maybe you're missing some of the pieces. So maybe you have some money, but you don't really have a track record or some experience. So you should maybe try to go network and find somebody that has a little bit of experience, and then you can maybe team up together, use your capital, their experience, or vice versa. Like you don't have any experience. I mean, you have a little bit of money, but you're hungry and you're willing to work and have a lot of drive. You find someone that's got a busy professional that is willing to kind of sign on your mortgage, because you gotta get the debt, you got to get the equity, and you got to get the deal, and you got to put it all together. So, just try to, if you don't have something, you just got to be very self-aware about what you have, what you bring to the table, what you're missing, and then go try to find a solution for everything you're missing. And at the end of the day, you kind of put a deal together. So one of the things I like to say, I like to use a lot of analogies. I've already used a couple. So another analogy I like to use is, no one ever comes to my house or my office and gives me money. So if I want to, or a deal, right? If I want to go get money or a deal, I got to go out and get it. So you got to go get networks. You got to go to places where other people that are interested in investing in real estate are, and you got to get to know them and build a relationship. You just can't do that behind your desk. And then if you want to go get deals, the brokers control the deals. So then you got to go get in front of the brokers and build a rapport and relationship with them, because they're not going to sell you a deal if they don't know you and or like you. So those are just things that you have to, get out of your comfort zone. I know a lot of people that do this are engineers by background, and so they aren't naturally like the networking outgoing types. You kind of got to get out of your comfort zone and go out and do it.
tell me how I know. I'm personally an engineer myself,
Yeah.
an
Right.
IT guy. I mean, and from a platform of experience, personally, Michael, I own, over 200, rental units and apartments and things like that, like almost a $40 million portfolio, right? So with the 20-year experience that I have here, Michael, a lot of times I hear on podcasts or any other sort of educational webinars and things like that, there's typically some gurus advising other folks that, oh, you can get into multifamily and things like that. And, you just need somebody to, partner with you and you can get in. And I find it like pretty dangerous that someone can just try to get into multifamily like that. And, I wish really all the success for them, but I feel that it's such a huge red flag that people should just doesn't know that you're trying to get into something that you just don't have much experience about.
Yeah.
What are your thoughts that do you recommend, like, some people that, hey, maybe get few renovation experiences, maybe have some house experiences and things like that, maybe duplex, triplex, whatever they may be?
Yeah, for sure. I mean, education is really it. So if you listen to podcasts like this one, or there's a bunch of good podcasts out there, like we have a podcast, Old Capital Real Estate Investing Podcast. So that's
Absolutely.
on Stitcher, anywhere you find this, you probably find us. So listening to podcasts are an easy thing to do. That's free and that's easy. You're reading books are free and easy, but from there, there's a lot of local real estate investing clubs. So in particular, if you're in a major metropolitan area, there's probably a real estate investing club around that focuses on multifamily. So that's a good way to go kind of get network to meet experienced people. I think, if you start small and kind of scale up, that's a good way, because the mistakes you make on smaller dollar amounts versus the bigger dollar amounts and kind of slow up. That's a little slower way of going about it. I've seen a lot of people here in Dallas. There's a bunch of these types of groups and clubs. And, if you find a reputable mentor, someone that's, reputable and has done this before, go out there and you pay them. That's certainly a good way to kind of shortcut the process.
Sure.
But, it's not inexpensive to go that route. It's going to cost you money. But, at the end of the day, if you make one mistake on a large scale apartment complex, you can cost yourself, well more than whatever that fee is. Plus you eventually lose someone's hard-earned money that invested with you. So, I've seen a lot of people be successful with it. So just make sure you make sense, and the person that you're talking to actually has actual experience doing this. As we get longer in the cycle, I keep seeing more and more of these guys that pop out of nowhere.
Sure.
That have done a deal or two, and all of a sudden they're super experts, and they're going to teach you how to do it for $20,000.
Right. Very dangerous. Yep. Absolutely. Yeah. Absolutely. Now, speaking of multifamily loans, I know they are very well structured, very well balanced with the right leverage and things like that. Could you maybe give insight to our listeners about multifamily loans, like how Fannie, Freddie, or bridge loans? Why would you use sort of a bridge debt and things like that? But more importantly, like, this is not just a residential loan that, somebody can, fog a mirror and try to, get a loan and get into a house. But with multifamily, there are just so many checks and balances. Could you maybe give us some insight and intelligence into these?
Yeah. So, when I'm thinking about putting debt on a deal, I always kind of start with the end game in mind. So if we're going to buy a deal, renovate it and flip it in 2 years, then, a bridge loan might make a little bit more sense. And so the bridge loans are typically, historically always been kind of like with your regional community banks. I hear lately there's been a lot of like debt funds that come out that are doing a whole bunch of that type of lending. So there's a plethora of bridge options right now out there. But if you're buying something, you want to own it for a 5-year period or something, the agencies, Fannie Mae and Freddie Mac are not only two largest lenders in the single family space, they're the two largest lenders in the multifamily space. So there's a bunch of great loan products out there, and they tend to be anywhere from 5 to 12 years long. It kind of tends to be the term, with most of these being either 7, 10, or 12 years on term. And you can typically today get multiple years of interest only on the front end. The 30-year amortizations will go up to 80%, so long as you have a 1.25 debt coverage ratio, meaning that your net operating income, underwritten NOI is 125% of your annual principal and interest payment.
Sure.
They'll loan you up to 80%. So it's getting a little harder. So most of these deals today are kind of capping out around somewhere between 70 and 75. But, I think the lenders are being really prudent today, and they're having really stringent underwriting, and they're holding to it. What they're doing is they're kind of just getting cheaper on their spreads, and so they're just kind of dropping their price, but they're holding the credit standards. So I'm thinking that the marketplace overall is pretty healthy from that standpoint. But once you get in and you can qualify for Fannie Mae or Freddie Mac loan, I mean, you're getting non-recourse debt, meaning there's no personal guarantee that you have to sign on it. You're getting loans that are assumable, so I could sell my property and you come in and take over my mortgage for me.
Very attractive. Yep.
They allow what they call supplemental financing, meaning that if I buy a deal, I renovate it, I increase the value, they'll give you a second lien cash out note. Maybe 2-3 years down the road, and let you re-leverage the loan back up without having to pay off your first. So they're really, good quality products, and that's really what's helping the marketplace quite a bit. Is the debt that's out there is available and abundant, and the agencies really do subsidize our industry in a lot of ways by providing us very favorable debt terms.
Awesome. So now, speaking of analyzing deals, Michael, how do you go about analyzing deals? Is that like sort of a in-house team that you have? Could you maybe share your sort of your team structure? How do you go about that?
Yeah. So when the way we're set up is we have 2 offices. So I kind of head up our Dallas office. My partner Sean heads up the Austin office. So up here in Dallas, my primary responsibilities are asset management, kind of overseeing the properties that we have. Raising all the money, investor relations, I do taxes, and, source deals. Down in Austin, he also helps source deals. They pretty much run the transaction. So underwriting and analyzing deals, placing the debt, running escrows, just kind of handle that then there. So when we get a deal in the front door, the basic kind of screening process is if someone calls me up, a broker calls me up, I have such and such deal, I kind of basically do a quick little analysis and say, okay, is this a deal that's the right type of product, the right vintage, the right location, and the right size? If it doesn't pass it, I kind of kill the deal. If it passes it, then we'll spend a little bit more time. Then we kind of go into like the price. So, okay, it's $100,000 a door. That sounds like a good price. Or it's $100,000 a door. That sounds crazy expensive for that type of deal from what I know. So a lot of the deals get kind of killed just right there, just because it just is just too expensive on there.
And if I may, Michael, there, I know your market very well. I mean, you pretty much know that, okay, what's a deal or what is a possible deal and what's really not a deal. Yeah. So at the platform of experience that you have, is it more of a napkin math for you that, hey, I just know this right away, that there is some potential that we may try to, poke further, versus like, are you?
Yeah. So that is like
right. So
that's the first gut check. Then if it passes that, then we'll do a real quick analysis. So I'll spend like 15 minutes. So we'll just do some high level projections. And a lot of times these deals get killed right then. And if it passes the high level projections, at that point, I'll go out and tour the deal. And then I'll go out and we'll actually, if I tour the deal and it makes sense from that point, then we'll actually do a full underwriting on the deal. And then when we do a full underwriting, we're spending 4 or 5 hours underwriting the deal, doing rent comp survey, expense. And so, I'm trying to make sure the biggest cost I have in my life right now is opportunity cost. So if I spend time on this thing, it's at the expense of something else, another deal, spending time with my kids, whatever. So I'm trying to do my best to kill a deal as soon as possible, so I don't spend a bunch of time on stuff that's never going to work. And that's what experience, I think, kind of believes you. Because when we do a full underwriting, we're spending 4 or 5 hours on it. So the more underwritings I can avoid spending 5 hours on, the better off I am, if that makes sense. But I don't know if that answers your question or not.
No, it does. It does. And I think, as you rightfully said, like the amount of things that you have going on, there are like a lot of important things on the plate rather than some potential deal that perhaps may not work out. So your ability to spend the time on the right things is extremely important. So good, I appreciate it.
And not just me, that's everybody, right? And that's hard when starting out, like, because you don't have that experience. So that's where, when you're starting out, you have to go down these rabbit holes you're never going to get. Then you learn like, okay, this never was going to happen. So every
Sure.
deal that you do when you're starting out, you should just kind of go back and reflect, like, should I have recognized that this was not a deal earlier on to save me 4 hours
Right.
of my time, because I spent 4 hours on this instead of the next thing.
Sure, sure. So in your journey of career, Michael, what is sort of the best advice as related to investing that you have gotten so far?
I think that's a good question. Best advice, I've got a lot of pieces of advice. I mean, I think, this is, like I said, as a business, like I mentioned, you can't do from behind your desk. When you're doing this business, I think you need to be very specific about what you're looking for. So when you're starting out, maybe you don't know what that is. So you need to kind of look at a lot of stuff, but at some point, the most successful people I've seen have been very targeted and very specific, and they become masters of one thing. Like I buy light value add stuff in suburban Dallas, Fort Worth, and Austin. I don't do self storage. I don't do office industrial. So
Sure.
I see a lot of people that are kind of jacks of all trades, and I never really get a whole lot done. Or they buy like a deal in Toledo and Indianapolis and Dallas and Jacksonville and this and that, and they're like
Sure.
one-man band, and so they're always just out there scattered everywhere. So I think if you can focus on one thing and become an expert on a location and a product type, you certainly can be more successful. And then I think another thing would be it's a business of partnerships in a lot of ways. So I found a primary operating partner in Sean that has very different but yet complementary skill sets of mine. He's like a genius when it comes to analyzing and underwriting deals, but he's not so comfortable talking in front of a group of people and raising capital. So what we found is when, if you find a good partner and you guys join up and do it together, we're not able to produce twice as much work by that. We're able to produce 4 or 5 times the amount of the work and production. Because I focus on what I'm good at and he focuses on what he's good at. So we're a lot more efficient at the things that we do. Like I can do a lot of pretty much anything he can do, and he probably can figure out everything I'm doing. He just wouldn't be very good at half of that job that I'm good at. So if you do get into partnership, give it some thought and be intentional and strategic about who you partner with, and make sure they're not the exact same personality type as you, because then that's not as the best efficient way of forming partnerships.
Sure. Very great advice. So multifamily is a relationship and a sort of a multi-team sport game, basically.
It is.
Absolutely. So thank you, Michael. Please share regarding a podcast. I know Old Capital podcast that you and Paul Peebles co-host. I mean, it's a wonderful source of knowledge. I recommend all listeners to check out YouTube's, SoundCloud, all the social media platforms where, the Old Capital podcast is available. Could you maybe share sort of a general background around how it came about?
So there's I appreciate that. So the really a couple ways to find out information about me. Really the best way is if you guys like podcasts, you like apartments, which you probably do if you listen to this one right here.
Absolutely.
Our podcast is for, I like to say, it's for apartment nerds, right?
Sure.
So if you're into apartments, it's the one for you. So we talk to it's my partner, Paul Peoples, runs a company called Old Capital. And so he's a very prominent, successful mortgage broker that makes loans on multifamily properties all across the country. And he's based in Dallas as well as I am. And so we'll talk to clients or brokers or management companies or insurance people, anything in and around buying and operating apartment complexes. So if you go to iTunes or Stitcher, you can just type in Old Capital, find it there. The other way to find more information about us really is my company is SPI Advisory. So the best way to find out more information, or maybe I'm always happy to have a little conversation with people from the podcast. Simply go to my company's website, which is www.spiadvisory.com. That's SPI like spy advisory.com. And on there's a contact us form. If you fill that out, I'm always happy to set up a 10 or 15-minute call with listeners off of a podcast. So.
Awesome. It's been a pleasure having you, Michael. The platform of experience and at a level you are, I think you have unique insights that all can learn and sort of grow to a level that you are at. So it's been a pleasure having you, and I appreciate you spending time with us today.
Thank you for having me on. I appreciate it.
Thank you. Have a good one.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.